there is a conflict here between the standard, provide for deferred tax liability, and the framework, deferred tax is not a liability at all. And the reason deferred tax is not a liability at all, if you listen to the framework, is there is no present obligation to sell the asset. Because there is no present obligation to sell the asset, there's no present obligation to pay the tax. There's a conflict between the standard and the framework, which means we must follow the standard, but we can criticise the standard. Yeah, it's an interesting academic point. Yeah, arguably we're overstating liabilities on the balance sheet. So, the framework defines a liability as a present obligation. The tax will only be due when the asset is sold. The tax will only be due when the asset is sold. On the revaluation, there is no present obligation to sell the asset. On the revaluation, there is no present obligation to sell the asset. Therefore, there is no present obligation to pay tax. So on the revaluation, there's no present obligation to sell the asset, and therefore there's no present obligation to pay the tax. Therefore, per the framework, deferred tax is not a liability. Per the framework, deferred tax is not a liability. So, per the framework, deferred tax is not a liability because you're not under a present obligation to actually pay it. Now, where there is a conflict between the standard and the framework, we know that you must follow the standard. We know that you must follow the standard. But it opens up an academic debate. It opens up a weakness, it opens up a point of criticism that we can have. So I don't know how this might end up being examined. There might be a question which is about the framework, about the definition of a liability, and then we're bringing in deferred tax as part of the discussion, or the question might be about deferred tax, and you're bringing in the framework as a little bit of a flavour to the deferred tax question. Yeah? But it's an interesting juxtaposition. I need to move on from deferred tax. Otherwise, you'll think the whole exam is going to be on deferred tax. And, there's been many an exam with no mention of deferred tax at all. But to me, deferred tax is important. If it comes up, it's not a big number crunching topic. It's an ideas topic. Deferred tax. Going. Going. Going, going, go. Going, going, go. Deferred tax is provided for on all year-end temporary differences. The temporary difference between the carrying value of your assets and liabilities and their corresponding tax base. If you revalue an asset, the carrying value goes up, we report a gain. The tax base remains the same. Disallowed, the gain is not taxable, and so you have a taxable temporary difference with a deferred tax liability. That's there. Oh, I'm going to sit down now for a second. Right, several accounting standards now that ideally